Welcome to BigONE Weekly News Update. I'm Gavin. The cryptocurrency market continued to weaken last week after the recent wave of leveraged liquidations. Bitcoin, BTC, dropped 5.5% to around $108,640. Ethereum, ETH, fell 4% to $3,670. Binance Coin, BNB, plunged 15% to $1,100. And Solana, SOL, declined 4.6% to $188. Globally, U.S. equities rebounded as trade tensions with China eased and concerns over U.S. regional bank debt subsided. The S&P 500 rose 1.7%, the Nasdaq gained 3.5%, and the Dow Jones advanced 1.56%, while the Russell 2000 fell 3.29%. Gold extended its winning streak for a ninth consecutive week, whereas oil prices retreated by 2%, aftermath of a $19 billion deleveraging shock. The market continues to absorb the $19 billion liquidation that occurred on October 11th, one of the largest forced unwindings in crypto's history. With trading platforms now more interconnected than ever, the structural shock triggered broad chain reactions across assets. Data suggests that the systemic leverage ratio, comparing total derivatives, open interest to crypto market capitalization, excluding stablecoins, peaked near 7% before the event, nearly double its early May level. Following the deleveraging, it dropped below 4%, returning to early 2025 norms. This adjustment underscores crypto's procyclical tendency. Speculative leverage builds in bull runs, amplifying downside risks when sentiment shifts. While the cleanup may restore stability, short-term price movements remain uncertain. Altcoin leverage returns to safer territory. Before the liquidation, the altcoin open interest dominance ratio had breached the 1.4 caution threshold, a level repeatedly observed before prior liquidation cycles. After October 11th, it fell to around 1.2, signaling reduced systemic risk. However, a near-term Bitcoin rebound is not guaranteed, as future movements will likely hinge on macroeconomic data and global liquidity conditions. Macro landscape, policy turns, and market tensions. Although equity markets have enjoyed several months of steady gains, two-way risks are re-emerging. Early in the week, Fed Chair Jerome Powell hinted that the ongoing quantitative tightening, QT, could end within months. Yet, reports of bad debt exposure at several U.S. regional banks later sparked volatility. Goldman Sachs' CEO invoked the cockroach theory, cautioning that isolated problems might spread systemically. Despite QT nearing its end, elevated use of SOFR and SRF facilities indicates persistent short-term dollar funding pressure. The next FOMC meeting is scheduled for December. If the SOFR RRP spread remains above 20 basis points and SRF usage stays positive, analysts expect the Fed could not only cut rates but also officially conclude QT outlook, conditions aligning for recovery. Over the next 2 weeks, a combination of macro and geopolitical developments could bolster risk sentiment. The end of quantitative tightening and continuation of rate cuts, an extended suspension of U.S.-China trade tariffs, containment of U.S. regional banking risks, a resolution to the government funding impasse. Together, these factors could provide the foundation for a gradual rebound across digital assets and global markets. The recent deleveraging marks a pivotal moment for the digital asset ecosystem. While volatility may persist in the near term, the forced reset in leverage and improved liquidity conditions could serve as a healthier base for the next growth cycle. As global monetary policy enters an easing phase and cross-market linkages strengthen, disciplined risk management and macro awareness will be key for navigating the evolving landscape. Join BigONE today and take advantage of the growing cryptocurrency market.